Do you know that the United Kingdom, a country that still feels wealthy, confident, and globally important, quietly relies on money from the rest of the world just to keep its economy balanced? Not because it is poor, not because it is reckless, but because that is how it has chosen to function. From the outside, Britain looks sturdy. London's skyline signals power. The pound still carries historical weight. British institutions project calm competence, the economic equivalent of someone wearing a tailored suit while insisting everything is perfectly fine. But underneath that calm surface sits an uncomfortable truth. The UK consistently spends more than it earns on the global stage, and foreign capital fills the gap. Quietly, relentlessly, every single year. This is not a scandal. It is not a conspiracy. And it is certainly not unique to Britain. But the scale, persistence, and normalization of this dependence make the UK unusual among advanced economies. Imagine a household that lives well, owns impressive furniture, travels frequently, but relies every month on friends buying its assets, lending it money, or covering shortfalls. No one panics because the household has a good reputation. But the arrangement only works as long as the confidence remains. That confidence is global, and global confidence is famously emotional. Understanding how foreign money underpins Britain explains things that often feel disconnected. Sudden swings in the pound, political U-turns after market reactions, fragile growth despite strong headlines, and why financial markets seem to have an unofficial seat at the policy table. This matters now because global capital is becoming more cautious, more selective, and more political. And when the flow slows, even slightly, the effects travel quickly from trading floors to mortgage rates to supermarket prices. Before we begin, a quick request. If you enjoy calm explanations of uncomfortable economic truths, the kind that don't shout, consider subscribing. The deficit that never leaves. Britain has a habit that rarely makes headlines. It buys more from the world than it sells to it. Year after year, decade after decade. This is called a current account deficit, which sounds technical but is surprisingly simple. The UK imports more goods, services, and income than it exports. The difference must be paid for somehow, and that somehow is foreign capital. Historically, Britain did not operate this way. During the industrial era, it exported manufactured goods and earned income from overseas assets. Those surpluses funded stability at home. But over time, the structure of the economy changed. Manufacturing shrank. Consumption rose. Services expanded. Imports surged. Services, particularly finance, do generate export income, but not enough to offset the sheer volume of goods Britain imports, from food and fuel to electronics and machinery. The gap remains. Instead of closing that gap, Britain learned to live with it. The solution was elegant, if risky: sell assets, attract investment, and allow foreign money to balance the books. Foreign investors buy UK government bonds. They buy shares in British companies. They buy property, sometimes entire neighborhoods. And the deficit quietly disappears, not solved, but financed. The overlooked contradiction is this. Britain's economic strength depends less on what it produces and more on how attractive it looks to outsiders. That is unusual for a country of its size and history. Who benefits? Financial services, asset owners, and regions tied to capital inflows, especially London. Consumption stays high. Prices feel manageable. The system appears stable. Who loses? Manufacturing regions, exporters, and households exposed to inflation when capital flows wobble. The adjustment cost is rarely shared evenly. The real risk is not collapse, is sensitivity. When confidence weakens, even slightly, the pound falls, import prices rise, and living standards are squeezed. The public experiences this as a cost of living crisis, rarely as a balance of payments issue. The subtle truth mainstream coverage avoids is this. Britain has not eliminated its external weakness. It has outsourced it to global investors. And as long as they remain willing participants, the system functions. The question is not whether this is good or bad. It is what happens when confidence becomes conditional. And that takes us to the city where that confidence is traded daily: London. London, the world's favorite middleman. London does not just attract money, it hosts it. Every day, trillions of dollars move through London's financial system. Currencies, derivatives, bonds, equities, much of it belonging to someone else. The city acts as a global switchboard, routing capital between continents. This is a remarkable achievement. It rests on deep markets, legal credibility, time zone advantages, and institutional memory. Few cities can replicate it. Fewer still have tried successfully. But here is the quiet contradiction. London's success does not necessarily reflect the productive strength of the wider UK economy. It reflects Britain's role as a trusted intermediary. Think of it as running the world's most efficient toll booth. The traffic is global. The fees are lucrative, but the vehicles are not British. During calm global conditions, this model thrives. Capital flows in easily. Tax revenues rise. Employment grows in finance, law, consulting, and real estate. During stress, the same capital can leave quickly. Financial money has no hometown loyalty. It does not wave goodbye. It simply updates a spreadsheet. Who benefits? Highly skilled professionals, asset managers, and sectors tied to financial intermediation. London's ecosystem prospers. Who loses? Regions and industries outside the financial core. The dominance of finance pulls talent, investment, and political focus away from broader economic development. The overlooked truth is that London's strength increases national dependence. The more the UK relies on financial intermediation rather than production, the more its fortunes track global market moods. This also shapes politics. Policies are often evaluated not only for social impact, but for how markets might respond, a word that quietly means foreign capital holders. Britain has become exceptionally good at making global investors comfortable, less good at making growth. When Britain is owned from abroad, walk through Britain and you will see familiar brands, familiar infrastructure, familiar utilities. What is less visible is who owns them. Large portions of the UK economy, from airports and energy networks to water companies and commercial property, are owned by foreign investors. This did not happen suddenly. It accumulated quietly over decades. In many cases, foreign ownership filled a genuine gap. Domestic capital was limited. Public finances were constrained. Overseas investors brought funding and expertise. The issue is not ownership itself, it is scale. When profits flow abroad year after year, they subtract from national income. When investment decisions are made by global portfolios, local needs become secondary. Who benefits? Pension funds, sovereign wealth funds, and global investors seeking stable returns. Consumers may benefit from continued operation and investment. Who loses? Domestic investment capacity and long-term strategic control. The economy becomes more externally financed, less internally driven. Debt, markets, and the price of trust. The British government, like all governments, borrows. What matters is who lends. A significant share of UK government debt, gilts, is held by foreign investors. Central banks, pension funds, asset managers, institutions that evaluate risk calmly, impersonally, and continuously. When trust is high, borrowing is cheap. When confidence wavers, yields rise. This is not punishment. It is arithmetic. The overlooked truth is that fiscal policy does not operate in isolation. It operates under global scrutiny. Markets react faster than parliaments, and sometimes they react louder. Who benefits? The government gains flexibility during stable periods. Investors gain reliable returns. Who loses? Policy autonomy during stress. Sudden shifts in sentiment can force rapid adjustments, often felt by households rather than institutions. This does not mean democracy has vanished. It means it operates within financial boundaries that are rarely acknowledged openly. The UK's model works until it doesn't. Not because it collapses, but because it tightens. Quietly, gradually, through higher borrowing costs, weaker currency, and slower growth. And that is the central, unsettling truth. Britain's economic stability rests not on crisis management, but on continuous reassurance. The system does not shout. It whispers, and whispers, when ignored, eventually the pound, a confidence meter disguised as a currency. Currencies are supposed to reflect economic strength, production, trade, productivity. The pound sterling, however, behaves more like a mood ring. When global investors feel comfortable about Britain, politically, fiscally, institutionally, the pound holds steady or rises. When confidence wobbles, the currency reacts quickly, sometimes dramatically. This sensitivity is not accidental. It is structural. Unlike currencies backed by persistent trade surpluses, the pound depends heavily on capital inflows to maintain its value. Britain imports far more than it exports in physical goods, from energy to food to manufactured products. Those imports must be paid for. Capital fills the gap. As long as money flows in, the pound remains supported. When inflows slow, the currency adjusts, politely at first, then more firmly. A weaker pound is often described as helpful for exports. This is technically true, but it is also expensive. Britain imports essentials. When the pound falls, prices rise. Inflation follows. Living standards feel the impact before exports feel the benefit. Who benefits? Exporters, tourists, and sectors earning foreign currency. Asset buyers may also benefit from cheaper valuations. Who loses? Households, especially those on fixed incomes. Import-dependent businesses. Anyone who eats food or uses energy, which, inconveniently, is most people. The overlooked contradiction is this. Britain experiences currency movements not as a reflection of productivity changes, but as a referendum on confidence. Markets respond less to factories and more to policy signals, political stability, and credibility narratives. This creates a delicate balancing act for the Bank of England. Raising interest rates can support the pound by attracting capital, but higher rates slow growth and raise mortgage costs. Lowering rates can support growth, but risks currency weakness and inflation. It is not incompetence. It is constraint. The pound is not fragile because Britain is weak. It is sensitive because Britain is open and dependent on flows it does not control. For emerging economies, this dynamic is familiar. For Britain, it is still treated as an exception. And this sensitivity feeds directly into a deeper issue. The missing engine. Why Britain invests so little at home. One of the quietest problems in the UK economy is also one of the most damaging, chronic underinvestment. For decades, Britain has invested less, consistently, than comparable advanced economies. Less than Germany, less than France, less than the United States. The gap is not dramatic in any single year. It becomes dramatic over time. Low domestic savings play a role. So does a pension system that prioritizes liquidity over long-term national investment. Corporate incentives often favor short-term returns. Political cycles reward visible consumption over patient capital. Foreign investment stepped in to fill the gap. And at first, this looked like success. Projects were funded. Infrastructure appeared. Capital arrived. But reliance became habit. Who benefits? Projects that might otherwise not exist. Regions able to attract global capital. Governments that avoid difficult reforms. Who loses? Domestic financial depth. Long-term productivity. Economic resilience. The subtle truth is this. When foreign capital is always available, the urgency to mobilize domestic capital fades. Why reform pension systems when overseas funds will buy the assets? Why build long-term institutions when markets are willing to step in? This reliance also shapes priorities. Foreign capital seeks returns, flexibility, and exit options. National development requires patience, coordination, and sometimes lower immediate returns. The result is visible in aging infrastructure, uneven regional development, and weak productivity growth. Britain did not lack money. It lacked direction over where money flowed. Emerging economies recognize this problem instantly. They are often warned about hot money dependence. Britain rarely applies the same caution to itself. Instead, foreign capital became a substitute for domestic ambition. And that substitution has consequences. Not today, not tomorrow, but steadily, quietly, over time. Which brings us to the final question. Can this balance hold in a world that is becoming less a stable system with a narrow margin? Britain's economic model works. That is important to say clearly. It has delivered stability, prosperity for many, and global relevance long after industrial dominance faded. It is not broken, but is finely balanced. The UK sits at the intersection of global capital, legal trust, and institutional credibility. That position brings benefits and responsibility. The system depends on reassurance, consistency, and openness. But global conditions are changing. Capital is becoming more selective. Geopolitics is intruding into finance. Competition for investment is intensifying. In such an environment, dependence becomes more visible. Who benefits from the current model? Global investors, financial intermediaries, and economies that rely on Britain as a conduit. Who carries the adjustment risk? Households, workers, and regions when confidence tightens. The overlooked systemic truth is this. Britain has traded self-sufficiency for flexibility. That trade-off worked well in a cooperative global system. It is more challenging in a fragmented one. The next 5 to 10 years are unlikely to bring collapse. What they may bring is pressure to narrow deficits, strengthen domestic investment, and rebalance growth away from pure financial intermediation. None of this requires rejecting foreign capital. It requires reducing reliance on it as the primary stabilizer. For emerging economies watching Britain, the lesson is uncomfortable but valuable. Even advanced economies face external constraints. Even reserve currencies answer to confidence. Even long-standing institutions depend on flows they do not command. Britain is not uniquely vulnerable. It is uniquely honest, if one looks closely. The quiet danger is not dependence itself. It is mistaking confidence for permanence. Because confidence, like capital, moves. Closing, calm, reflective. If you stayed this far, thank you. Consider subscribing if you value explanations that treat you like an adult. And share your thoughts below. Is economic independence ever real or only managed? Sometimes the most stable systems are the ones with the least room for error. And sometimes the scariest truths are the calmest ones.